Per usual, living on this channel for educational purposes only, and it's not intended as financial advice. It's Teaching Tech Tuesday. I'm getting some questions about stablecoins. So let's do a little deep dive here, as well as some tradable signals towards the end of the video. If you have no idea what stablecoins are, the first of which was Tether in 2014. It was created to represent a digital version of a dollar. This is a centralized service. Ideally, the reserves are held in a bank. Ideally, the reserves are liquid. Ideally, the reserves are audited. That's where all of them need to be. As an American, ideally, I want these in an American bank, but I can understand companies or individuals which do not agree with that statement. Throughout the years, we've had a few stablecoins come and go. Tether and USDC are the dominant leaders. USDC has always been the little brother to Tether. Tether has been the predominant offshore vehicle of choice. Early on, it was the predominant way to send dollars into offshore exchanges, which did not have USD availability and never would get connections to banks. That just would never happen. So it was kind of DeFi before DeFi. Without stablecoins, USD pairs on non-US exchanges really didn't exist. In the early days, it was BTC pairs, if we're talking Cryptsy, or the early days of OKCoin or Binance. The other impetus for creating Tether was to have a non-volatile safe haven for risk off, for times which you just wanted to sit in dollars and you didn't want to sit in BTC. So ultimately what it ended up doing is creating a massive offshore non-US exchange market. And only later on did it become a way for non-US individuals to basically have a US bank account. And that's essentially what Tether acts as today for many in the global south and Africa and Asia and Europe who want access to USD. So a few others have cropped up over the years. We can look at them all on a few services, CoinGecko being one, DeFi Llama being another. These are on different chains, different networks. They serve different purposes. They have a different user base and clientele, and we will see these come and go. It's kind of the general stablecoin explosion. We had algorithmic stablecoins. We still have some of those. We have fractional stablecoins, but what most people really want is a trusted digital dollar that they can easily transfer outside of the banking system, not in a bad way, not necessarily for nefarious activity, just to have that ability to quickly transfer as you can Bitcoin, ETH, any other altcoin. Most people are probably never going to touch any of these outside of Tether and USDC. One reason you would venture off the beaten path would be for yield. Different coins here are going to offer different yields or different yield schemes. Some of these are going to be gold. I'm kind of surprised we don't have like a Tether silver or other types of stable coins here that are pegged to something other than the dollar. We saw PayPal come in. We tried to see, or Facebook tried to create their own basket for a stablecoin. That failed. You're getting closer to stablecoin legislation in the United States that will bring clarity to what this can and can't be. There's clarity in Europe through the MICA legislation. So all this is very much in flux if you're watching this years from now. But if you want to look at the data, CoinGecko is good, DeFi Llama is good. And on DeFi Llama, we can look at where most of the issuance is sitting per chain. Some people are always surprised when they find out Tron actually is the dominant Tether chain. If you talk to anybody who's traveled in South America, in Asia, in Europe, people asking for Tether, they don't want it on ETH. They want it on Tron because of the cheap transaction fees. Most people don't care about the centralization. Most people just want access to something that is not their own currency. And Tron is the cheapest way to transfer Tether. And that's that. So that's why most of the issuance is sitting there. Exchanges play a part in this. Individuals play a part in this. And most of DeFi has kind of adopted USDC over Tether based on my own opinion. So it's kind of different strokes for different folks, different use cases here. But Tether is mostly sitting on Tron, whereas USDC is mostly sitting on Ethereum, Base, Solana, and a few others. Now, if you really wanted to do your own due diligence and look at all these and say, these are what they are, these are the market cap, if you want to dig into the companies and the exchanges and the holdings and the custodian, you can go on and on and on. The DPEG history, that's fun if you haven't lived through that. But for the most part, again, most people are going to be sitting in one of these two if they're ever using stablecoins for anything, and will very unlikely to be exposed to anything else. So I'm going to focus on those two for this video. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. One thing that's interesting these days is when you go on any exchange, your favorite exchange, mine is Kraken, but they will have different denominations of everything. Not all these pairs are going to have the same liquidity. You're not going to have the same USDC pairs that you have on Kraken as compared to other exchanges, ETH, DAI. So it really fractures the liquidity picture a little bit. And in a way, just having a BTC denominated system was somewhat easier and less complicated because it was the only gig in town at the time. I'm thinking about Cryptsy, just flashbacks to those exchanges that are now defunct and no longer here, but it does make things a little bit interesting depending on which exchange you're using. If we want to look at and talk about reserves of the top two stablecoins, Tether and USDC, Tether historically has been very poor with the transparency. They've gotten much better over the years. Gone from hardly any attestations to quarterly attestations. I would love to see some sort of daily report here. I would love to see better auditors involved, but whatever, right? It's offshore. It's BDO Italia. Okay, that doesn't really mean anything to me, but I'm sure people in the auditing game know who they are and what they are. And in those reports, as well as this little graphic here, you can see it's not just T-bills, it's not just cash, it's not just money markets. It's a little bit of everything across the board. And they kind of get a pass here because they are the biggest stablecoin. They are the dominant leader in the market. And they can pretty much do whatever they want within reason. And we saw within reason what that meant in 2018 when they were briefly insolvent. But they've certainly been, in my opinion, on the straight and narrow, on the up and up over the years. And things have gotten a lot better. USDC Circle is more of the direct appeasement to U.S. regulators. They desperately want a U.S. regulatory moat. They desperately want an IPO. Their money sits on U.S. shores and U.S. banks, specifically Bank of New York Mellon, managed by BlackRock. We can look at the composition on a daily basis. We can look at the flows according to them on a daily basis. We can look at the Circle Reserve Fund, fully transparent, again, through BlackRock. So Tether could certainly do better. But for most people, they could care less. It's good enough. It's good enough. It's functional enough. Especially people using it overseas as currency. They don't care about the holdings or the reserves as much as they care about this thing works. It's worked for X period of time. I trust it. Okay, great. So to U.S. regulators, Circle is where they would want Tether to get, I'd imagine, if some bill passes where there's some regulatory moat. We're probably going to see non-U.S. users get kicked out of the Tether ecosystem on centralized exchanges. And Circle Coin USDC would like that for their own business very much. Again, both are centralized. I'd show you the seizures here in a graph form on the block, but unfortunately for the video, that data website portion is not working, but here's where you find it on the data section of the block. Something else to track are the mints and burns directly on Twitter. This is one of the accounts that tracks that. You can track this in Telegram. You can get it fed through Discord, all sorts of fun stuff. But this gives you a heads up of stablecoin demand. If we're seeing stablecoins being minted, that is very likely a representation of money going out of the fiat system and into the crypto system. The crypto system needs inflows via wires USD, or it needs a healthy stablecoin flow. And we'll look at that in a graph in a second. So regardless of where this ends up or where it's going or what happens with it, the most basic response should always be, this is good for crypto. This is more money outside of the fiat system that's coming into crypto. So over time, we can track this. I get a lot of questions about, how do I track this? How do I track dominance? How do I track reserves? What does that mean? So let's go over that. This is how you pull this up on TradingView. CryptoCap USDT for Tether, CryptoCap USDC for USDC. It's a good idea to understand the lead lag relationship, the general dynamics, the correlations between stablecoins and alts, stablecoins and BTC. Now that we have the ETFs for BTC and soon ETH, stablecoins for those two cryptocurrencies are less important. We have a direct spigot from the printing press into crypto now. It doesn't have to go through a bank. It doesn't, well, it does in a way, but it doesn't require all this additional friction, all these additional steps. Anybody with a brokerage can access this stuff. So these days, stablecoins are certainly very important for things like Solana and anything else down the list, and definitely important for offshore exchanges, decentralized exchanges, where this is essentially the lifeblood of what runs most of this stuff. Outside of cryptocurrencies themselves, we really need those dollars in the ecosystem to keep prices rising or to keep prices high. Outside of these two, Binance USD, BUSD was also a competitor that was slapped with some legal trouble and has been unwinding over the past many months now, almost, I guess, over a year now. So really, these are the only two that are left. What's going to be interesting is once we get that regulatory blessing from the US legislature, will we see free banking stablecoins, essentially where any bank, any exchange can create their own stablecoin under certain parameters and under certain rules. Now, as far as ratios and things, we can look at that directly and we can say, okay, in a bullish environment, what does the stablecoin supply ratio look like? Stablecoin supply ratio is coin market cap relative to stablecoin market cap. So if the ratio in purple there is high when we're bullish, low when we are bearish, you can kind of think of this as inverse stablecoin dominance. So there's more stablecoin in the ecosystem relative to total crypto market cap at the bottom, at least at the bottom in 2022, compared to the top in 2021. Had we not had the ETFs, you might think, oh, stablecoin supply ratio up here, it's actually dangerously overbought if this were some sort of Z-score oscillator. And unless we get more stablecoins in the ecosystem, it's going to be harder to keep prices up here. But with the ETFs, again, I don't think it's as much of an issue. And if we compare this to, can we compare it to ETH? No, we cannot. So the dynamics of the market are changing for Bitcoin and ETH, less so for alts. And we can tease that apart with things like Total 2. So if we're looking at Total 2 versus Tether and USDC, you can just put this into TradingView as USDT plus USDC using that CryptoCap calculation. And this is something we were talking about in Q3 2023 into Q4 2023, where what alts really needed the most wasn't necessarily just a bullish BTC, but they also needed stablecoins coming back into the ecosystem because of the massive drain that had been happening throughout 2022 and 2023. So much like the global liquidity index or some global liquidity index, you always want to see number go up. Number go up, stablecoins should mean number go up. For altcoins, more liquidity in the ecosystem equals more dollars in the ecosystem. A liquidity starved, dollar starved stablecoin or altcoin market is bearish. It really is pretty simple, and it really is one-to-one. Despite having several tier one crypto exchanges, including Kraken, where you can wire in money, this is one immediate direct way you can monitor the liquidity in the ecosystem. So it's great that the absolute value of stablecoins is rising, but just isolating this range with Total 2, it's much different. Stablecoin month over month change, barely up versus the previous month over month, quarter over quarter change in Q4 2023 into Q1 2024. That change was huge. That rate of change was massive. So most of these liquidity metrics, reverse repo, global liquidity index, most of them are very similar. If I have this other graph here, adding onto the stablecoin market cap, if we look at US liquidity, global liquidity, Bitcoin price, stablecoin market cap, it isn't a surprise that global liquidity rising on a year-over-year basis month-over-month basis, corresponds largely with stablecoin market cap. Is it a perfect correlation? No, but it's a loose correlation that is pretty obvious, and you can monitor it very easily with a simple equation in TradingView. We can also look at stablecoins as a percentage of US liquidity continues to rise. We can look at that relative to total crypto market cap continues to rise. This is all a very good thing for us. It is unlikely that regardless of where stablecoins are used, who uses them, or why, but it's unlikely if we saw a decline in stablecoin circulating supply, we would see a rise in crypto prices. Generally, those things are one-to-one. If we zoom into 2023 and 2024, stablecoin circulating supply as a percentage of US liquidity. Clearly, in the orange here, the total market cap took off first. So it's hard to say all the time what's leading what here, but it's more about understanding the dynamic and understanding if there's a divergence here. Are we seeing crazy stablecoin prints and prices going nowhere? Well, that would be a bullish divergence. Are we seeing a ton of stablecoin burns, stablecoin coming out of the ecosystem with prices holding at, I don't know, 150K, 200K, 350K? That's something to watch for into 2025. Do we see a stablecoin drain out of the ecosystem, much like we saw throughout 2022? So understanding the basics of the headwinds and the tailwinds is certainly very, very helpful. And then we can look at today's picture for total 2 relative to stablecoin. We can see in 2021 and 2022, this was pretty correlated pretty tightly, especially into 2023. Since 2024, total 2 has risen pretty substantially, whereas total 2 relative to stablecoins has fallen a little bit and is not nearly as high as it was in 2021. So what do we always want to see? We always want to see the system flooded with stablecoin, flooded with liquidity relative to total market cap. It is harder to hold up the entirety of the ecosystem without stablecoins. So you never want to see those reducing, or you do if you're bearish. If you're bearish, all you want to see is stablecoins getting sucked out of the ecosystem. That represents money moving from crypto into the fiat world. TradingView does have a stablecoin dominance indicator. So this would be the selected stablecoins relative to Bitcoin in this case. And you can see stablecoin dominance got pretty high at about 15. Currently it's around 6.5. Does it matter for BTC as much? I don't know, right? We'll find out with the ETFs. I don't think it does. I think, again, we have a direct impact with the ETFs, whereas something on page 63 of CoinMarketCap or whatever, yeah, they benefit a lot from stablecoin. So another way to think about this is more stablecoin in the ecosystem, more risk eventually gets into the ecosystem, more leverage is able to be created in the ecosystem. And maybe a simpler way to look at this is year-over-year change. So this is year-over-year change of stablecoin supply relative to Bitcoin. And you can see the difference here in 2020. Not only do we have the GBTC stuff going on, not only do we have Sailor, not only do we have post-COVID stimmies and PPP loans and just this explosion of liquidity that we've never seen before, we also had a lot of that making its way into stablecoins. And if anything, this early year-over-year change that happened in September preceded the eventual October-November move of Bitcoin. So that was a huge signal. Now, I don't know if that signal is ever going to be the same again because of the ETFs. Now we have the ETF flows we can look at. If, for example, ETF flows are exploding, prices going nowhere, we have to investigate that. What's going on? Is this basis trade? Is this something else going on? But since 2023, despite the absolute value of stablecoin circulating supply being quite high, we didn't really see this move that much. So for BTC, probably less important, at least this cycle. Even total 2, if we zoom out again, it's pretty obvious when the stablecoin stuff started taking off in 2020. That was almost a full quarter ahead of the explosion in total 2. And then at the very top of total 2, we already saw stablecoins coming out of the ecosystem. And this isn't even including Anchor or any of that stuff. So it's a pretty interesting signal looking back on it now. Great. Okay, can we use this going forward? Well, if we look at just since January, again, this inflection point is suspiciously similar to that horizontal breakout period in November, where we saw reverse repo drain, inverted head and shoulders breakout. And here we're seeing a massive change in year over year stablecoin prints. So sometimes it leads, sometimes it lags, but you always want to see it as a confirmation. You always want to see more money coming into the ecosystem. And just going back to this chart real quick. So what do we want to see going forward? It's good that we are seeing a rise in stablecoin circulating supply, but from here, it may be pretty hard to push up total 2 unless we do not see similar stablecoin growth. If you isolate Tether relative to everything else and compare that to ETH, it's pretty obvious that, hey, all this stablecoin comes in. Where's it going? It's bidding. It's max bidding. It's leverage. So it's a pretty good idea to understand what's going on there. That's all for this one. Like, dislike, comment, share, subscribe, and happy trading.